Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi.
All right, Imogen, we're going to start with you because where else would we start any week in autumn, I think, but the UK. So the first question is, we've had a tumultuous day on the political side. Perhaps you can just talk us a little bit through that.
Yeah, I'm going to be sad when this is all over and the UK is relegated to the end of Bondcast again. But for now, we're enjoying being, somewhat enjoying being centre of attention, I suppose. So we're recording this on Thursday, and anyone with an eye on UK politics will know that that means that Liz Truss, our Prime Minister, has just resigned, and the leadership process to get a new Conservative leader will begin, and a new Prime Minister, of course, will begin with plans that this should be completed by the end of next week, such that the budget process and the DMO remit and the ABR projections, etc., can still go ahead as planned on the 31st of October. There's a lot of question marks right now around what that process will look like and also who's running. What we do know is that, I guess, who were considered kind of the main contenders going into the speculation that Liz Truss's time might be running out, Hunt has already declared that he won't be standing, and there is some speculation that Boris Johnson might be standing. Graham Brady, chair of the 1922 committee, made a statement earlier that suggested that this could go to party membership if there are still two candidates in the running. I presume if they want to have this concluded within a week, that means it will have to go to some online vote with the party membership, although it has long been a kind of base case that actually most MPs would like to avoid this going to membership, and therefore their preferred route would be to have a single candidate remaining in this leadership contest. Apart from Boris Johnson, the other kind of two top runners, I would say, before there was real speculation that he would also run, were Rishi Sunak, or still are Rishi Sunak, and Penny Mordaunt. When it comes to a markets perspective, I think that Rishi Sunak can probably be considered, I guess, from where we are now, from a fiscal policy outlook, as the kind of continuity candidate, and that his policies wouldn't look particularly different from what Hunt has rolled back on. And now I've just realised in saying that actually we haven't even done a Bondcast since we've had that reversal in fiscal policy, even though it feels like it was 2 weeks ago. It was actually only a couple of days ago. But I'm sure listeners don't need me to update them on what happened there. So I think Rishi Sunak can be considered kind of the most market friendly when it comes to the yield outlook, I suppose, and the fiscal policy outlook. And Boris Johnson, perhaps the sort of least market friendly amongst those three candidates, which is really what I think we're seeing in the market reaction with the news that Liz Truss is resigning. I suppose when it comes to politics, like I say, the other major news this week was that we had this rollback in terms of a U-turn on around 3/4 of the tax measures that were announced, or the tax cuts that were announced in the mini budget. And I think our kind of market outlook as a result of that is still little change. Listeners of this pod will know that we've been talking for a while about how the bulk of the additional borrowing this fiscal year is all about the energy package, and although that has changed beyond this, or is set to change beyond this fiscal year, that still makes up a vast proportion of the borrowing this year, and is likely to still matter quite significantly next year, although it will be slightly less generous, more targeted perhaps, and less costly than it was previously projected to be, but there's still this kind of significant jump in gross supply, which also comes at a time when the Bank of England are coming back to the market to sell bonds as well. So we still remain pretty bearish gilt yields. It's our 10-year target after Monday's update was 4.3. Now we obviously need to wait for a little bit to kind of see how this leadership process is going to take place. As we're recording this literally at 3 p.m. on Thursday rather, we don't have any of the details of that. So it's maybe a little bit under review, depending on how likely it looks that Boris may or may not be coming into power again. But for now, we stick with our 4.3% 10-year gilt target.
Wow, very comprehensive answer. I know that you've repeated most of that answer a dozen times probably already today, but thank you very, very much for that. So moving on to the Bank of England, which is the week after next, of course. I think it's the 3rd of November, if I'm not wrong. Obviously, we have between then everything that you've just been talking about on the political side. So we may have, I guess we expect to have a new prime minister. We expect perhaps to have confirmation of the budget, plus all the OBR stuff associated with that. And so hopefully the Bank of England will be going into this actually reasonably well informed about what the fiscal side of the equation is. So can you put all of that together for us, please?
Yeah, so it looks like the bank will have, as you say, all of that information and be able to use that to feed into their projections, because this isn't just an MPC, but it's one of their quarterly inflation report meetings. So we will get updated macroeconomic projections and forecasts from the bank. So it's a relatively important meeting. And I think it's important from a couple of perspectives. First is that clearly there has been despite the fact that there's been a U-turn this week on some of the fiscal measures, and obviously now the Prime Minister, who will be the next Prime Minister, is kind of hanging in the balance, and what that implies for fiscal policy has a question mark over it. But from what we know right now, there still has been fiscal loosening versus the September meeting, and definitely versus the August meeting when they last updated those projections. So I think to the extent that you would expect that to imply, pressure for higher bank rate, that still holds. Now, Pill and Bailey, after the mini budget, they both had reiterated this idea that a significant fiscal loosening required a significant monetary policy tightening response. Now, that fiscal policy loosening is much less significant now than it was, but it still is loosening. So we still think that the kind of basis for a larger hike than we had in September is justified. The other important point is that given that they now have more information around the fiscal outlook, or they should have more information around the kind of medium-term fiscal outlook, they will or should return back to using the forecast as their kind of guidepost for monetary policy. So listeners will probably remember that we thought there was a fairly hawkish reaction function shift back in the August meeting and followed through in the September meeting, where they really departed from using those medium-term projections as a kind of essentially as part of their forward guidance, if you like, on the direction of travel of monetary policy. It appeared that they were just much more concerned, and their policy decisions were much more influenced by spot inflation than they were their medium-term projections, because if you remember, over their medium term they had inflation well below target and were forecasting a recession, yet we're still signaling that bank rate needed to get to higher levels. So they should return back to more normal policy signaling, I suppose, but we still think that the fiscal loosening and the still high inflation outlook, that was the other thing. We've also had inflation data this week, which returned back to double digits and marginally surprised to the upside in the UK, probably justifies a 75 basis point hike. And that is slightly revised down versus our previous post mini budget call that it would necessitate 100 basis points worth of hike in November. We haven't heard from many MPC members since the U-turn on the mini budget on Monday. We did hear from Broadbent today. He was pretty clear, more clear actually than I remember many MPC members being, that the market was mispricing or overpricing how much tightening needed to be delivered. And he used a couple of nice charts in there, one in particular which reiterated a point that we've made a lot and probably made on this podcast a few times, that actually the bulk of the tightening that's been delivered so far by the bank actually hasn't really been felt by the real economy yet, largely due to the structure of the mortgage market and how long people's mortgages are on a fixed rate for, and therefore a huge proportion of the market until now hasn't really been rolling off onto significantly higher rates. And he put a chart in that showed that the tightening that's currently being implied by the market in terms of bank rate peaking at around 5 probably about 5.2 when he did the analysis, suggested over a kind of 3 or 4 year time horizon, a 5 percentage point hit to GDP, which is quite a significant kind of cumulative hit to economic growth, and probably not one that the Bank of England need to hike into. So we stick with our call of 75 basis points. I think his comments today kind of vindicate that view as well. And I guess the other important thing to think about just with the Bank of England, which we will hear more about prior to the November 3rd meeting, but the other news this week, sorry, there's so much to talk about in the UK, is that they kind of confirmed that active sales will go ahead as well. So there'd been a bit of a question mark around whether that part of quantitative tightening would progress as planned, given everything that's happening in the political and market backdrop. But they have confirmed that it will go ahead as planned. The major difference is that they won't be selling long bonds, at least for this quarter, and they will reassess that decision at the end of this quarter with a view to perhaps adding them back in Q1. So we've seen a large or a quite sizable long end outperformance in the UK this week, which actually now feels a little bit overdone to me, to be honest. But we will hear more detail. Well, by the time listeners listen to this, we will know more details about the auction schedule and the size of those auctions, but also those sales will have begun before the 3rd of November MPC. And I will stop there because I think that's enough on the UK. And probably by the time anyone listens to this, everything could have all changed anyway. But before the Bank of England, Giles, we have the ECB next week. And although I've been very distracted by what's been going on in the UK, there's also been a lot of ECB speak and a lot of discussion there as well about QT, I suppose, but also this reserve remuneration and TLTRO theme that we discussed last week. So perhaps you can just give us an overview of what you're expecting from next week's meeting.
Yeah, okay, so on rates, first of all, we're looking for 75 basis points, so bang on consensus there. I don't think that there'll be many people looking for anything different, to be honest with you. The market is about 73, 74 basis points priced in. So I don't think that we're looking for a big miss or a big surprise on that. But it is going to be a particularly interesting meeting for a number of reasons, and unusually, I suppose, because between the forecasting rounds, when the next one, of course, is in December, there are some big other questions. So first of all, we are calling for an announcement on quantitative tightening. So not to start immediately, but I think it makes sense for them to announce that now rather than in December, so that we can kind of prepare ourselves mentally, I suppose, if nothing else, for that start in January. So that's the first thing to say. And then the second, we're also looking for an announcement on tiering to essentially to negate the beneficial or the benefit, I suppose, to banks in their net interest income deriving from the TLTRO3, which is very, very favourable funding, and which has become, frankly, a communications problem, possibly also a monetary transmission problem for the ECB. So, just very quickly going into that a little bit more on quantitative tightening. We are looking for that to be probably a bit of a soft start, probably. So passive, that's the important point. No question of active sales. To be honest with you, there may never be a question of active sales in Europe. But if there ever is, it's for a long time from now. So the main question is, do they just stop reinvesting overall, or do they just allow a certain portion of the maturing assets in the APP to mature, and they reinvest a portion? I think they probably do that. There's about 325 billion of assets that run off over the next year, and I think if you just think about what that means in relation to total supply, for example, monthly gross government bond supply runs at about 90 billion. If they don't, they might be adding 25 billion or something like that to that figure, 20 billion per month. So, it would be quite a big shift if they were to just stop reinvesting. So I think that, as a rough guess, We haven't been especially scientific, and I'm not sure that you can be, but I think that it sits reasonably well with other international comparisons if they do about half of that. So that's the first point. The second point on tiering, I guess that I've already said what I expect, that they will do this in a way to negate the benefit of the TLTROs to banks. In fact, I think they'll probably try to do this in such a way as to encourage banks pretty strongly to repay their TLTRO cash. So that may be a market consequence worth looking out for. What I don't think that they'll do is to reorganize things in order to pay nothing on excess liquidity, which is something which is in the debate, particularly also in the UK, but I don't think that's a possibility.
And so what are the kind of market themes or the trades that fall out of that?
Okay, so quantitative tightening, I think, is a sort of soft consensus at the moment in the analyst community, but I don't really feel like it's particularly priced in. Maybe in a small way, we have had a little bit of a suggestion of a pivot in curve dynamics more towards steepening, but frankly, I think that has more to do with the fact that we're fully priced at the front end rather than any real consideration of what quantitative tightening might mean for the long end. Overall, as a rough guess again, but a rough guess which is drawing on our Bund fair value model and some of the estimates that the ECB has made for the value of quantitative easing on long-term rates. I'd say you might be looking at about a reaction of 10, possibly even 15 basis points overall to that, if that's where we're going. But of course, between then and now, if markets focus more on this meeting and these risks, we could price that in by then. So that's the total value of that sort of announcement, I think, from where I'm talking right now. The other thing is that I think the quantitative tightening makes it less likely that they follow through as aggressively at the front end in rate hikes as the markets are expecting. And so I think that it adds up to pretty clear kind of curve steepening risk, things like 2s, 10s in particular, but possibly even wider on the curve than that.
Okay, and I guess a little bit more of a niche subject, but still one that moved markets a lot yesterday. And you described it as exciting, so I'm going to use that too. The other thing that excited markets was to do with the German, the Finanzsekretär, and what they announced with regard to their repo facility and how they were going to change that, I suppose, in light of the potential increase in supply that might be coming on board, given announcements on the German fiscal policy side. So perhaps you can just run us through what they announced and why it's so exciting for markets.
Yeah. Okay, so it's a very exciting, but also quite niche topic. So I'll keep the answer short. So what the finance agency did was to increase the size of some of its lines, some of its bonds, so that it could use them in the repo market to borrow money at actually very, very cheap rates. And the value of this to Germany, of course, is not only that it's cheap, but it's also quite flexible funding. It allows them to dip in and out of the market in sort of quite a short-term way. They do this anything from overnight to term repo into next year. The value, I suppose, is that they have quite an uncertain funding profile, perhaps, over coming months, because over winter and with all the economic uncertainty and this 200 billion spending envelope that's been created by the federal government, the details of which we still don't really have, it's very difficult for them to make detailed plans far in advance, of course. And so what I think we do know is that there will be an economic incentive for them to use this. And there's also, I think, a funding logic for them to be reasonably persistent in this market. And so yesterday we saw a big reaction in the front end, both in outright levels and in asset swaps across the curve, but led by the front end. And I think Now, while there are bigger fish to fry between now and the year end, because the year end turn is always such a significant funding event, I think that this does give you a little bit more comfort on the funding side for anyone who's short bonds, so in particular anyone who is expressing an asset swap tightness. So I think that this is a little bit of extra grist for the mill, and improves the risk reward looking ahead to next year, potentially reasonably substantially. So that's, I think, another one to monitor.
Thank you, Giles. All right, last but not least, then let's switch over to you, Jan. I guess the US has taken a little bit of a backseat this week to the UK and Europe. But one thing that I have noticed that's kind of been brewing as a theme is this idea of, well, I guess potential spillovers or more caution around what's happened in the UK and that affecting other markets. How is that playing out in the US this week?
So there have been discussions whether anything that happened in the UK or just kind of disorderly movement in longer dated yields, anything like that could spill over into the US. And I think the trouble there isn't as great given the sheer size of the market, the reserve currency status of the dollar, and like the more structural holders that aren't really going to have to make these rapid adjustments on kind of like, or at least, I mean, that's kind of like our read for now. Of course, there could be some, I guess that's how these tail risks and black swan events work. Like if I could know them now, then they wouldn't be black swan events. But in any case, one of the topics that people have linked to what was going on in the UK was the Treasury coming out last week and sending the survey to primary dealers asking, well, what are your thoughts on potential buybacks? I don't think that it was related to the UK experience, given that they've asked this question in 2015. They asked the TVAC to do a look into the issue in August. So it has been in the works for some time, and it's not even a guarantee that it's going to happen. They most likely will collect the answers from the dealer community. They asked a bunch of questions, and they might want to see if it's operationally feasible or is the kind of like cost to putting a program like this in place worth it. So I can kind of run down what we think if a program like that existed, or do we think a program like that should exist, and maybe go over some of their questions in, I guess, in no particular order. But in my view, yeah, I think it does make sense to have a facility like that in place. And just to clarify, we would look for a temporary facility that would be addressed at supporting liquidity in off-the-run market, where people have been punishing these kind of bonds that are not the current ones, or bonds and notes, because everyone wants to be at the most liquid point right now, particularly since the general liquidity outlook in the US hasn't been as great. And that makes sense to me. The Fed is hiking in 75 basis point increments. We're having QT running at a fairly rapid pace. So when monetary policy tightens this fast, it is not entirely surprising that for example, the front end of the curve is a little unloved. That being said, I think that if they did go ahead with a program like that, it would come. This year looks a little bit too rushed, so probably early next year, maybe even at the February refunding announcement is where they could start. And again, to repeat, I do think that they should make it very clear that it will be a temporary program that is going to be conditional either on the pace of monetary policy or what they could dub as general market conditions. But as I think liquidity has been influenced by monetary policy, and I would envision a program that phases off at the end of next year if the Fed turns around and kind of stops QT as we expect towards the end of 2023, and then we get rate cuts in 2024. Of course, markets will position themselves a little ahead of time before the cuts are actually materialized. They also were curious about what sizes they would do and which parts of the curve. I think the underperformance of the 20-year, the newly introduced 20-year, well, 2 years now, but the newly introduced 20-year has been a topic in this podcast as well. And it could have been one of the reasons what prompted Treasury to discuss these buybacks in general. I don't think that temporary buybacks would be the solution to the kind of like the hump in the 20-year part of the curve that has been formed. However, if they're really want to promote liquidity, I would think that front end to the belly of the curve, so like 2s, 3s, 5s, 7s is kind of where you want to extend it to, not much farther out than there, maybe even 7 years a stretch, and keep it in there where the market depth has been notoriously thin recently. So, and I would not even include tips or floating rate notes in that equation, because they're not really the sources of kind of like when you think about liquidity in the US or kind of like sourcing cash or repo, it's not really where you go for raising funds or kind of lending out funds. Additionally, like I said, kind of like only into next year, and how would they fund it is one of the other questions. There are two really main options. They could increase auction sizes across the curve, or just auction size of the notes that they're buying, which would be basically add 2 billion or 3 billion a month on 2 years, just so you can use those proceeds to buy back all their stuff, and make it kind of cash neutral, or issue more bills. There is a lack of bill supply in the market still. There's plenty of demand even with QT going on. So they have some leeway there to expand issuance and use those proceeds to buy back some off the runs. I think I lean towards a mix of both of the combinations. I don't think issuing bills on top of what you have to fund QT to buy back notes is a very sustainable, I guess, or like a sustainable approach to debt management. But there is demand that I don't think it's necessarily dissipating. And as far as sizes go, like I said, I'm pretty agnostic. I think it's going to be one of those things where the dealer community passes around some numbers, and of course it will be different. What you buy for 2 years is significantly different than what you would buy for a 20-year bond. So it wouldn't be equivalent in cash terms, but rather more so like a duration adjusted term. So, but I don't think they should be anything that large. So like our guess when we first wrote about it, kind of proposed numbers around 3 to 5 billion per month. Per line. So it really doesn't go that much. I think more the psychological impact will be just as important, that there is an additional liquidity provider and there will be someone at a pre-announced schedule coming to buy securities from you. So I think if they do, they start early next year with all these parameters that we discussed, but I don't think it will be something that they're going to rush into by the end of this year. That being said, it certainly has supported the 20-year part of the curve, and it has provided a little bit of a bump in off the runs and expectation that they might be buying in that. So who knows, maybe it will be fixing the sector until we return back to the reach for yield environment where the highest yielding securities are back in vogue.
Okay, interesting times for sure in fixed income markets. All right then, guys, I think we will leave it there for this week, because I certainly need to get back to the desk and see what's going on in the UK. We will catch up on all of this next Thursday. Have a good week, everyone. And just a reminder to our listeners, if they like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.